People spend a lot of time asking what stock to buy next. That question almost always comes from the wrong place. The far more important question is how to behave once you own something. Because behavior, not intelligence, determines whether investing works over time or fails quietly in moments of stress. Most people don't lose money because they chose the wrong company. They lose money because they chose the wrong moment to panic, the wrong moment to sell, or the wrong moment to believe they were smarter than the market. The first thing to understand is that investing is not trading. Trading is about movement. Investing is about ownership. When you buy a share of a business, you're not buying a ticker symbol. You're buying a small piece of an operating company that produces cash, employs people, and competes in the real world. If you wouldn't be comfortable owning the entire business for 10 years, you have no business owning it for 10 minutes. Markets exist to serve you, not instruct you. Prices move constantly, but price movement alone tells you nothing about the value of what you own. The market's job is to offer prices. Your job is to decide whether those prices make sense. Most people reverse those roles. They let the market tell them how to feel. When prices rise, they feel smart. When prices fall, they feel foolish. That emotional loop is what destroys long-term returns. A business does not become worse simply because its stock price goes down, and it does not become better simply because the price goes up. Businesses change slowly. Stock prices change quickly. Confusing the two is costly. One of the great advantages individual investors have is the ability to do nothing. Institutions don't have that luxury. They have mandates, benchmarks, and quarterly pressures. You do not. You can sit still. And sitting still, when done correctly, is a powerful advantage. When markets fall, most people ask, "What should I sell?" The better question is, has the business changed? If the answer is no, then the price decline is not a threat. It's an offer. The stock market is the only place where people run out of the store when everything goes on sale. That behavior makes no sense anywhere else, yet it happens every cycle. Volatility is not risk. Volatility is the price of admission. Risk comes from not knowing what you own, or owning something that depends on favorable conditions to survive. That's why quality matters. Strong businesses with durable advantages, honest management, and predictable economics can endure bad times. Weak businesses cannot. Over time, that difference becomes enormous. Another common mistake is holding too much idle cash out of fear. Cash feels safe because it doesn't move. But safety is not the same as productivity. Cash has a role. It gives flexibility. It allows you to act when opportunity appears. But excess cash, left idle indefinitely, quietly loses purchasing power and opportunity. Money should either be protecting you or working for you. If it's doing neither, it's simply sitting there out of habit. The goal is not to be fully invested at all times. The goal is to be properly invested when the odds are favorable. That requires patience. And patience is not something people are naturally good at. People want activity. They want to feel engaged. They want to believe effort equals progress. Investing punishes that instinct. The more you try to do, the more opportunities you create to make mistakes. The best investments often look boring. They don't make headlines. They don't require constant attention. They quietly do their job year after year. Holding through difficult periods is not an act of bravery. It's an act of rationality. If you've done the work up front, understanding the business, its economics, and its resilience, then the proper response to volatility is calm. Most people underestimate how much of investing success comes from temperament. You don't need extraordinary intelligence. You need emotional stability. You need the ability to be uncomfortable without reacting. Buying good companies when they are temporarily unpopular requires independence of thought. That doesn't mean being contrarian for its own sake. It means being willing to disagree with the crowd when the facts justify it. Popularity is not a business metric. Earnings, durability, and capital discipline are. Another trap is believing that frequent action improves results. In reality, activity often interrupts compounding. Taxes, fees, and mistakes accumulate quietly in the background. Compounding works best when it is uninterrupted. Time is its fuel. Every unnecessary decision shortens the runway. The ideal holding period for a great business is forever, not because you never reassess, but because truly exceptional businesses don't require constant replacement. Saving money is important, but saving alone is not the objective. The objective is to convert saved capital into productive ownership over time. Money sitting still does not grow. Money invested intelligently does. That process is slow at first, very slow, and that slowness causes people to abandon it right before it starts to matter. The early years require discipline with little visible reward. Later years reward that discipline disproportionately. Most people quit during the quiet phase. You don't need perfect timing. You don't need complex strategies. You need consistency, patience, and the willingness to behave rationally when others cannot. Investing is simple, but it is not easy. The difficulty lies not in understanding the principles, but in following them when emotions run high. If you can own good businesses, ignore noise, hold through downturns, deploy capital patiently, and avoid unnecessary action, the results take care of themselves over time, not because you were clever, because you were disciplined.